So good evening, everybody. This is the last of the sessions that I would be recording for you all. So this today I'll talk about 2 or 3 important topics. I'll just give you a gist about those. I know that 5 sessions is too little to cover up the entire syllabus. So I have thought since this is a banking law class, let me give you the salient features of the Banking Regulation Act. Then I will also talk about a bit about SARFAESI Act. Then I will talk to you about guarantees. Then maybe one small topic called garnishing orders. That there are so many others that are there, but I don't have the time to be spending on those topics. Okay, so I will share the screen relating to my presentation so that you will be in a position to understand and you will be in a position to read it in a easy manner. Okay. So first, we'll talk about the salient aspects of Banking Regulation Act. So basically, Banking Regulation Act was initially introduced as the Banking Companies Act, and it is introduced as an act with the purpose of consolidating and amending the law relating to banking. So it was started, there was a Banking Companies Act when the bank started failing in order to have a comprehensive regulation and also to assign the regulation to Reserve Bank of India, which was already acting like lender of last resort to banks. The Banking Companies Act was brought in 1949. It was enacted on 10th March 1949. And it was made initially applicable only to companies which are doing banking business, which are called your joint stock banks. Then the provisions were extended to cooperative societies doing business in 1965 through the Banking Laws Application to Cooperative Societies Act 1965. The background to it is cooperative societies were regulated by the Register of Cooperative Societies. But when deposit insurance and banks failed, deposit insurance was provided for banking companies. So when cooperative banks also wanted to get deposit insurance because there were cooperatives also which were failing. But at that time it was said that because banks were comprehensively regulated and supervised by Reserve Bank of India, they were more comfortable giving deposit insurance. But you come under regulation, and then we can consider extending deposit insurance to cooperative banks also, and that is how cooperative banks came into this purpose. But the problem remains that the regulation of banking business is with Reserve Bank of India. The incorporation, winding up, audit, and other aspects relating to cooperative management, etc., is with the Register of Cooperative Societies. So there is a dual regulation in it. So this way, cooperative societies for the Banking Regulation Act was made applicable. Companies Act was made applicable to cooperative societies, and so the title Banking Companies Act would not be any more appropriate. So the title was changed to Banking Regulation Act, and Section 56 was introduced in Banking Regulation Act, which is a complete reiteration of all the provisions of Banking Regulation Act by indicating which of these are applicable to cooperative societies, which cooperative societies they are applicable, etc. So that is as far as Section 56 is concerned. Then the provisions of the Act are in addition to other laws. So where there is a banking company which is coming under the Companies Act, then Companies Act provisions are applicable, Banking Regulation Act provisions are also applicable. But where there is a conflict between these two, the Banking Regulation Act will apply. Similarly, where there is a conflict between Memorandum and Articles of Association and the Banking Regulation Act, then the provisions of Banking Regulation Act will apply. Similarly, in case of cooperatives, you have bylaws. So where there is a conflict, bylaws are overridden by the provisions of the Banking Regulation Act. So the gist of whatever portions are there in the Banking Regulation Act, there are 11 chapters in this, and there are 5 schedules, 4 operational. The first chapter talks about, this is the scheme of the Act. There is a preliminary chapter. Then there is a chapter which talks about business of banking company, what it can do, what it cannot do. There is a chapter about control over management. Then a provision relating to supervision of board of directors of banking company where they are not functioning properly. Then prohibition of certain activities relating to banking companies. So banks are important premises and they cannot be abused by elements who are not happy. So that provision is protection which is provided for bank premises and banking business. Then acquisition of undertakings of banking companies in certain cases. So this is basically moratorium and all those kinds of aspects are the provisions which are there in the subsequent chapters. So this is acquisition of undertaking, then suspension of business and winding up, then special provisions for speedy winding up. So for the winding up of banking companies, the Companies Act or the Insolvency and Bankruptcy Code does not apply, but the provisions of the Banking Regulation Act apply. And the procedure for winding up is speedier. It is only technically speedier, but there are even Palai Bank and others winding up is still going on. Okay. Then the provisions relating to certain operations of banking companies like nomination, etc. These are aspects which are covered in this chapter. Then miscellaneous relating to penalties, rules, making power. Then offenses, levy of penalty by Reserve Bank. All these are there in the miscellaneous chapter. Then finally, chapter 5 talks about application of BR Act of the Banking Regulation Act to cooperative societies, which is section 56. There are 5 schedules. The most important provisions I will deal with. The licensing is a very important part. So no bank can function without license from Reserve Bank of India, and license will be given subject to fulfillment of conditions which are there in section 22. These conditions are ability to pay present and future depositors as and when their claims accrue. Then general character of management is not detrimental to depositors' interest. Then adequate capital and earning prospects. Then grant of license should be in the interest of public interest and depositors' interest. Then grant of license should be in the interest of consolidation of the financial system, etc. And the grant of interest should be in the interest of the operational banking policy, etc. These are the conditions that are there. Then existing banks, they have to apply, and only if the application is rejected will they cease to be doing business. But as long as their application is not rejected for license, they can continue to do business. This provision is applicable for our cooperative banks. There are several district central cooperative banks which are not licensed, but because their applications have not been cancelled, they continue to have their license and continue to do business. Then in certain cases, license can be cancelled also, like not fulfilling the conditions. Then if it is not doing banking business, then it is not in a position to repay the debt to the depositors, etc. In those instances, then if they are not complying with the directions, etc., provisions of the Act, etc., they can be the license can be cancelled. The appeal for this rejection of license or cancellation of license will lie to the central government, and central government decision will be final. It has to be filed within 30 days. Then branch licensing, no bank can open a branch without license. As far as licensing of foreign banks is concerned, foreign banks could be licensed in 2 manners. One, a foreign company which is having its branch here and doing banking business, that is one type. Second thing is foreign company opening a subsidiary here and that subsidiary doing banking businesses. This, but our banks also go out and have. So we will allow only those foreign banks to have operations here and give them license, where they will allow our banks to have their license. So in case of licensing of foreign bank, this principle of reciprocity is applied and it is followed. Then branch licensing, it is also no branch can operate. And when we say branch, it could be any operational branch, it could be a service branch, it could be an ATM. Any of these are treated as branches. Earlier, there used to be an individual license application, etc. But now what RBI does is there is an annual authorization which is given to the bank, indicating what are the plans in terms of opening of branches, shifting of branches, setting up ATMs, rationalization of ATMs, and that plan is approved and that has to be implemented. Then this is also subject to fulfillment of conditions which are there. Then business related provisions are there. First, as I told you, 5B talks about business of banking. Acceptance of deposits for the purpose of lending or investment, withdrawable by check, draft, order or otherwise, repayable by demand or otherwise. So this is basic banking business. Apart from this, what else they can do is indicated in section 6. So what our bank can do, it can do through the subsidiaries also. And what bank cannot do, it cannot do through subsidiaries. So if you see, there are certain insurance companies which are set up with banks' capital contribution. So they are basically operating as subsidiaries or having shareholding of the bank. So these have to be permitted. And only when they are permitted, they can do those businesses. They cannot do any other business. Then to make people aware of some institution to be a bank, they have to have in their name bank, banking, or banking company. Similarly, people who are not doing banking business and who are not licensed to do banking business should not have these words in their name. This is as far as Section 7 is concerned. Then there are certain activities which banks cannot do. One of them is they cannot be a trading concern. But when they have given goods to a trading company and he has not paid it, the bank can take over the stock as a part of enforcement of security, but it cannot hold it and do that business, because the principal business which a bank is supposed to do is banking, acceptance of deposits, lending, etc. Then they are not supposed to be trading in immobile property also. So any immobile property that they receive, they can use it for their own use or they can acquire it for their own use. But anything which they receive, they are supposed to be disposing of within a period of 7 days, 7 years, sorry. And in case they are not able to, they can take permission and have a further 7 years period for disposal of those immobile properties. Then they cannot create any charge upon any unpaid capital of the bank. So it is as good as if the charge will be invalid. Then they cannot create floating charge on the bank or any property or part of without a certificate from Reserve Bank of India. That is, the banking assets should be used for meeting the important liabilities of the bank, which are nothing but the deposits. So if I am going to have a charge and if I am going to draw upon it, the ability of the bank to repay the depositors will be affected. So that activity cannot be permitted without Reserve Bank's permission. So if Reserve Bank gives permission, they can create a floating charge on the bank on any property. And if RBI refuses, they can file an appeal with central government. Then this is the provision which I was talking about, that is obstructing entering or leaving of a bank, then holding demonstration in a bank to prevent normal business in a bank, then acting in a manner to undermine the confidence of depositors in the bank. All these activities, if they are performed by any individual, they are prohibited activities. And if anyone does this, he will be subject to liable for an imprisonment of 6 months and fine of 1,000, or he can have both. Then management related, there are several provisions. First, banks are professional organizations and banking business is special business. So they have to be managed by professional board of directors, and the requirement is not less than 51% of the board of directors should be specialists. That is, people with agriculture, economics, banking, law, finance. So those kind of special disciplines, called industry, management, finance, etc. So those accountancy. So those areas specialists should be there. Then there is a restriction on continuous tenure of directors, chair, etc. Hold chairman, managing director, not more than 8 years continuously. So it has to be, they have to be a dynamic movement of these people, so that no vested interest will be developed. Then there has to be a whole-time chairman or managing director for banks. So basically, you cannot do it like having a small shop. You go there one day and you don't go there. So it's a special business and it has to be managed at the top by a full-time chairman or a managing director. Then RBI has power overriding other laws to remove managerial or other persons from the office, or it can appoint additional directors. So basically, it has control over the management. So wherever a person, general character of management has to be proper and not detrimental to public or depositors' interest. That is one of the conditions for license. How does RBI ensure it? He will ensure it by saying that this person is not appropriate. He will direct that you remove that person. Second thing, he can appoint additional directors also. Then RBI has power to supersede the board. So entire board of directors can be superseded, and the power can be given to an administrator to manage the affairs of the bank. till a new board is constituted by the company, so by the bank. That power is there under section 36 ACA. So these are sweeping powers which are there for Reserve Bank of India. So it can ensure that the management of the bank is sound. So only when the management is sound can the institution be sound. This institution has to be sound because public trust it and provide it with money, and this money is driving the economy. So from that point of view, bank is a repository of public trust and public funds. That has to be managed properly, and that is ensured by having total control over the management of the bank. Then RBI may call for board meeting. They can call for board notes, minutes, etc. of the board. Then they can appoint an officer to attend the meetings as an observer. Then they can direct for change of management. All these provisions relating to management, they have absolute powers. Then specific regulatory requirements that are there, I have discussed. I will discuss a few of them. First is they are supposed to have a minimum paid up capital and reserves. So this is a very small amount, that is about 25 lakhs max. It is there. So this is the minimum capital, that is paid up capital, equity capital, and reserve. The real and exchangeable value should not be less than the 25 lakhs, 15 lakhs, 10 lakhs. So depending upon where you are going to have your head office, how many branches you have, etc. The provision is there, section 11. But that capital merely is not sufficient for an institution to run and do business well. So that is the reason why now the capital requirement for a universal bank is say 500 crores. And the capital requirement for a payment bank and a small finance bank is about 100 crores and 50 crores. So this is important because capital is the basis for dealing with shocks. So if an institution, a bank basically operates on the depositors, and the depositors' monies plus own funds are lent. But in case you don't get back the money, the fallback of option will be on the reserves which are created, then the capital which is there. And if both these are eroded, then deposits will be servicing. You have to take deposits to service deposits. Once this happens, the institution is a gone case. So to the extent that it doesn't happen, you need to have sufficient capital for the bank. What you have is a minimum regulatory capital. The other case you have through the prudential norms Reserve Bank specifies is what is called as a capital to risk weighted assets. So that is something which you don't need to discuss now, but that is also something which is very important. Then section 12 talks about the extent of authorized, subscribed and paid up capital and restriction on voting rights. The authorized capital is something which is there in the memorandum of association. The subscribed capital should not be less than 50% of authorized capital. Then paid up capital is that which you have issued and you have received subscriptions and the money has also come in. So paid up capital should not be less than 50% of subscribed capital. And the voting right restriction 10% presently, and RBI is thinking of increasing it to 26% in stages. Then requirement relating to dividend. Only when all the provisions etc. have been maintained, only then dividend can be declared. It is not like a profit-making entity that you are not doing your accounts, you are not maintaining provisions which are required to be maintained, and then you distribute dividend. That cannot be done. Then to enable strengthening of the capital structure, creation and contribution to reserve fund is specified under section 17 of the Act. So every bank is supposed to have a reserve fund, and 20% of profit after tax has to be invariably put in the reserve fund. And this fund, the appropriation from this fund can be made only for specified purposes with the RBI has to be informed about it, and it has to be made good within 21 days. So if someone doesn't want to contribute to the reserve fund, they have to approach central government for an order, and central government will not issue an order without the recommendation of Reserve Bank. RBI will not recommend if its paid up capital is and reserves are not sufficient. This is as far as the reserve fund. Basically, to shore up the net worth of the bank, reserve fund is stipulated. Then cash reserve requirement. So this, in case of non-scheduled banks, this is the amount which is called CRR, that is cash reserve ratio. That is a percentage of the demand and time liabilities which have to be kept in the form of cash or balances in accounts. But in case of scheduled banks, that is those banks which are there in section Schedule 2 of the Reserve Bank of India, they are called scheduled banks. So for those banks, the cash reserve requirement that is applicable is section 42 of the Reserve Bank of India. But for those non-scheduled banks, cash reserve is applicable in under section 18. In section 42, the only mechanism of holding balance for cash reserve is in a current account with Reserve Bank of India. Here you can maintain it in the form of cash, in the form of bank balance, other banks, etc. So that is as far as cash reserve. This is basically intended for meeting the short-term liquidity requirements of a bank. Then restrictions on loans and advances. RBI has power to impose restrictions on loans and advances in relation to capital. So don't give more than 5% for shares. Don't lend against unquoted shares. So these kind of what is the credit concentration norms or exposure norms? You should not give more than 15% to one company, more than 25% to one group of company in the form of loan. Then loan and investment combined, you should not give more than 40%. So all this in relation to own fund. The ability to impose such restrictions and the power to impose restrictions is with Reserve Bank of India under section 20. Then because directors and others and entities where directors have interest should not be siphoning off money in the form of having a loan, then the company saying that instead of 100 rupees you pay 50 rupees and your dues will be remitted. There is a prohibition on remitting dues of connected persons. That prohibition is there under section 28. They cannot do it without the approval of Reserve Bank of India. Then section 21 is basically the power of Reserve Bank of India to exercise control on advances by banks through directions. So basically the prudential norms directions, then the selective credit control, which is a monetary policy tool, all these were monitored or managed by RBI exercising the powers under section 21. Then section 24 is talking about maintenance of liquid assets, that is statutory liquidity ratio. This is also a monetary policy tool. So a proportion of their demand and time liabilities, that is deposits, have to be kept in the form of unencumbered approved securities like gold. Gold now is not in form, but generally in the form of government securities or government guaranteed bonds. The present percentage is about 20%. It keeps varying. CRR and SLR levels will be made up and down depending upon the amount of liquidity that is there in the system. Okay, it's a monetary policy. Then a return is supposed to be submitted to Reserve Bank, and in case of RRBs and cooperative banks, they have to submit to NABARD. RRB is regional rural banks. This is as far as section 24 is concerned. Then because banks are taking money from here, it's at least 75% of the assets have to be in India, and a return on the assets should be furnished to Reserve Bank of India under section 25. Then an annual return on unclaimed deposits, that is those deposits which are in accounts which have not been operated for more than 10 years. Those kind of deposits, an annual return is supposed to be submitted under section 26. So this money that is there has to be transferred to a depositor education and awareness fund, which is managed by a committee set up by the Reserve Bank of India. This is under section 26. Just like your investor education and protection fund for unpaid, unclaimed dividend and interest in case of capital market instruments. So this is a similar provision in case of deposits. Then here we are talking about those provisions where there is a supervisory element that is involved. That is, return will be submitted to Reserve Bank or NABARD, and based on this return, we will monitor what is happening as far as the bank is concerned. So these returns are tools of supervision of the bank also. First, submission of returns to RBI and NABARD, monthly return on assets and liabilities to monitor the CRR and SLR maintenance. Then on investment of bank and classification of advances, it has to be a half-yearly return. Then RBI and NABARD will publish the information in a consolidated form under section 28. Then this is repeated. Then final accounts, balance sheet and profit and loss account. as per Schedule 3 have to be finalized and they have to be done within 3 months of closing. That is, by June they should be there. Then the, in case now what is happening is banks are having subsidiaries which is doing life insurance, general insurance. So these are called financial conglomerates. So for these, merely looking at a bank will not be sufficient. I have to look at the entire group, like say SBI. It has an SBI Life, it has an SBI Mutual Fund, it has an SBI General Insurance, then it has SBI Capital Markets. So there are several institutions which are doing several functions with State Bank of India's capital contribution. So I merely having a picture of State Bank of India will not be sufficient, and the risks of one or the other business on the bank and on the other entities will have to be monitored. For this purpose, there is a power that RBI can call for financial statements of associate enterprises. In addition to it, a consolidated balance sheet also is to be drawn up and submitted to the concerned regulator. So this is to enable consolidated supervision of the financial conglomerates or systemically important. Not systemically important. So if these institutions which are there have a huge size and they are important for the financial system, they will be indicated to be systemically important financial institutions or banks. In India, you have three, as far as my recollection goes. One is State Bank of India, second is ICICI Bank, and third is HDFC Bank. So this is for consolidated supervision. Then foreign banks are supposed to display their financial accounts on their every office premises according to Section 33. Then audit of accounts and the report of auditor has to be furnished to Reserve Bank of India, and RBI has power to appoint auditors. Then submission of returns, they are supposed to submit annual accounts to Reserve Bank and NABARD, and NABARD in case of RRBs and cooperative banks. Then any other information which has been called for by RBI, it is the duty of banks to submit the same. Then another important supervisory power is inspection, and if it is specifically inspection is, I could have a general examination of the affairs of the entire banking institution. The other thing I can do is, specifically I found that in Punjab National Bank, there is this Nirav Modi scam. So I can send some official basically to look at the guarantees portfolio, which has resulted in this scam. Or there was a credit card fraud in a particular bank. So I can go and send some. This is called snap scrutiny. So this will be done by Reserve Bank of India in case of cooperative banks and regional rural banks. District central cooperative banks and RRBs, NABARD does the role as far as these institutions are concerned. As far as urban cooperative banks are concerned, RBI only conducts their inspection. So these inspections can be done at the instance of Reserve Bank of India or as directed by central government. So if as directed by central government, we do it and we find that the affairs are not appropriate, we furnish the report to central government and central government may prohibit the deposit acceptance. But if the position is worse, they can say, tell RBI, direct them that you go and file winding up proceedings against this particular bank. So RBI is bound to do under Section 37 of the BR Act. Then RBI has power to issue directions to bank in public interest, depositors' interest, in interest of banking policy, and for securing proper management. So these it can give to a particular bank or to a group of banks, and it can modify it or subsequently cancel this direction. So this is a very important power, basically to exercise control and to ensure that the institutions operate on proper lines. Your prompt correction guidelines are also basically directions of this nature. Then most importantly, the Banking Ombudsman Scheme is issued as a direction under Section 35A of the Banking Regulation Act. Then when Insolvency and Bankruptcy Code was brought in, certain amendments were made to the Banking Regulation Act, where central government by order could authorize Reserve Bank of India to issue directions to bank or banks to initiate insolvency resolution process in respect of default under the IBC. So non-performing assets is a problem with banks, and to deal with it, Insolvency and Bankruptcy Code is one of the mechanisms that you can take the institution for corporate insolvency resolution process. So to authorize the central government authorized RBI to direct banks to take up insolvency resolution process against their big defaulters, like you had SR Steel, then other institutions. So those institutions to be taken up for resolution process, central government can by order authorize. And this was a subject matter. So when central government gave a blanket authorization to Reserve Bank, and Reserve Bank issued a circular saying that we will do this and from this on February 12th of 2018 or 19, they issued this circular saying that this will be the mechanism that we will adopt, and this went to Supreme Court. And in Dharani Sugars versus and Chemicals versus Union of India, the Supreme Court held that the power that is there under this section is central government is not a blanket power that can be handed over to Reserve Bank of India, and RBI cannot. The circular that it has issued cannot be a generalized circular. It has to be for specific cases. So it cannot. The circular is beyond the power that is given to RBI. So they struck down that circular, and RBI issued fresh norms for dealing with stressed assets. Then RBI may issue directions to banks for resolution of stressed assets. Then to advise banks, RBI can set up committee or authority and appoint or approve appointment of any members to these committees to guide the banks insofar as resolution of stressed assets is concerned. Then the other provisions, there are several provisions relating to restructuring, winding up. So acquisition of bank. Central government may acquire a bank based on the report of Reserve Bank of India, and it can either hold it or can transfer it to some other institution. This is provided for. The provisions relating to this are contained in part 2. Then suspension and winding up. So where there is a particular institution, if it is solvent, but there is certain problem in terms of realization of money, etc. in that, RBI can apply to High Court for suspension of proceedings against the bank for a maximum period of 6 months. But for RBI, and it has to indicate that it is not a problem where the assets are not sufficient to meet the liabilities, but presently there is a liquidity problem. It is not a solvency problem. Solvency is your assets are less than, the value of assets is less than the value of liabilities to be paid out. So then you are insolvent. But here your assets are having value more than the liabilities, but presently you don't have cash or liquidity. So if it is a liquidity problem, then suspension is okay. But if during the course of these 6 months, if it is found that the bank solvency itself is a problem, then RBI will apply for winding up and for closing down that particular entity. Then High Court, based on this, can order the winding up, or they can suspend the proceedings against the particular bank. Then there is a scope for voluntary winding up. So they can apply to a High Court, but for this, RBI has to certify the ability of the bank to repay debt. So here also, if during the course of these proceedings, if it is found that the bank is insolvent, then RBI can convert this proceeding into a winding up proceeding. Not as a voluntary winding up, but a winding up under Section 38. Then amalgamation of banks for synergy, that is combining of two banks. That can happen, and for that RBI sanction of scheme and is required. So first there will be a scheme of amalgamation which will be drawn, then the shareholders will apply, then will approve, and based on the scheme approved by the shareholders, they will give to Reserve Bank of India. Reserve Bank may suggest changes or ask questions, etc., and finally may approve. If it approves, then the voluntary amalgamation takes place. If it doesn't approve, then that cannot happen. Example, the voluntary amalgamation. Earlier there was one Times Bank and HDFC Bank. They got merged. Then Centurion Bank merged with Bank of Punjab, which incidentally merged with HDFC Bank. So these are all mechanisms of like ICICI Bank and Bank of Madura. So these are not during distress that they got merged, but because of the synergies that are there that they get merged. Then moratorium and reconstruction or amalgamation of bank. So this can happen. Central RBI will write to central government, and central government will issue an order of moratorium. Moratorium is basically putting a stop on the operations of that particular bank. Then RBI prepares a draft scheme for reconstruction or amalgamation. And if the position of the bank is bad, then RBI will write to central government and say that you declare a moratorium, that is, hold up everything in the manner in which it is there. So till the time that I am going to come out with some solution. The solution that RBI is going to come out with will be a scheme of reconstruction or a scheme of amalgamation. And this scheme of amalgamation, they will put it in public domain, call for comments from all the stakeholders. Based on the comments, they will modify it. And this modified scheme, they will forward to central government. Central government will sanction, and accordingly, the further course of action will be taken up. Example is your S-Bank case that has happened recently. RBI ordered, asked central government, and central government issued an order of moratorium. Then subsequently, RBI didn't do amalgamation. It did a reconstruction of that. State Bank of India and some other banks brought in capital, and then Yes Bank was resurrected, and it is again back to operations. The other case that is there is your in case of PMC, etc. You had a there's some other bank which came about in problem recently, no? This is this case. So there was another bank which had a problem. Then Lakshmi Vilas Bank. So Lakshmi Vilas Bank is now likely to be taken out by another bank. So here a scheme of amalgamation has also been brought out, and Lakshmi Vilas Bank will be taken over by that particular bank. So this process is under part 3A. Then special provisions for speedy disposal of winding up is there in part 3A. Then operation related, there are provisions relating to preservation of records, rules to be prescribed by central government. Then specifically relating to nomination for deposits, for return of articles kept in safe custody, and for release of content of lockers in the safe deposit vault. Provisions relating to nominations are there in 45ZA, ZC, and ZD. Then no bank can honor the notice of claims from persons, other persons. Those provisions are there in ZB, ZD, and ZF. Then the miscellaneous provisions are relating to penalties, cognizance of offence, power of RBI to impose penalty, how will the fine be applied, etc. So that is one section. Then acceptance of deposits by withdrawable by check, only certain banks and the notified central government, notified institutions can do. That is under section 49A. Then no change of name can be permitted by central government without RBI's no objection. Similarly, no alteration of memorandum of article, memorandum of association of a bank can be done without a no objection certificate in writing from RBI. Then power of central government to make rules. Then central government has the power to exempt a bank or banks from certain provisions of the Act, subject to approval of recommendation of Reserve Bank of India. Then as applicable to cooperative societies, this is chapter 5, section 56 deals with Banking Regulation Act as applicable to cooperative societies. So when we say the provisions of Banking Regulation Act are applicable to three kinds of cooperative banks. One is State Cooperative Bank, or which is the Apex Bank. Second is Central Cooperative Bank, which is called the District Central Cooperative Bank. And the third is the Primary Cooperative Bank, that is an Urban Cooperative Bank. Popularly, it is called as an Urban Cooperative Bank. But the BR Act provisions do not apply to Primary Credit Society, then Primary Agricultural Credit Society, then Land Mortgage Banks, which are now called Primary or State Cooperative Agricultural and Rural Development Banks. So in this particular section, the mechanism of this section is that each provision of the Banking Regulation Act is taken, it is applicable or not applicable. Then if it is applicable in a modified manner, what is the modified application? So that way the entire provisions from section 1 to 56 will be indicated, whether it is applicable, whether it is not applicable, or if modified applicable, how it is modified and applied. Then there are 5 schedules. The first schedule is relating to amendments to RBI Act. Second schedule is relating to repeals, which has been repealed. Third schedule is relating to form of balance sheet and the schedules of under the balance sheet. Then form of profit and loss account and schedules under the profit and loss account. This has been modified for cooperative banks, and you have section 56 where a separate third and fourth schedule is there. And fourth schedule is in relation to the list of debtors at the time of winding up, etc. Then fifth schedule talks about principles of compensation, where there is a merger of banks and compensation to the acquired bank, what should be the mode, etc., will be indicated in this fifth schedule. This is as far as the Banking Regulation Act is concerned. Then now I have this SARFAESI. I will talk about it in even lesser detail than this, because it's a specialized act and it's a limited scope act. First, what is SARFAESI? Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act 2002. It was enacted on 17/12/2002, but it is effective from 21st June 2002. It is not a penal act, and it's a beneficial act for dealing with non-performing assets. So, retrospective effect will not have any problem. Then, what does the preamble say? An act to regulate securitization and reconstruction of financial assets and enforcement of security interest, and to provide for a central database for security interests created on property rights. So, what is involved here is, now earlier they used to be said as there will be asset reconstruction companies and securitization companies, but now in 2017 they have done away with the securitization companies and they are called asset reconstruction companies only. So these are companies which are basically taking over the assets. So imagine, I will give you a small example. Imagine that there is an institution which has given 1,000 rupees loan. Okay. So now this 1,000 rupees loan is recoverable in, say, about 15 years. Okay. So if it wants to multiply or if it wants to enhance the amount of money that is required, so for 15 years it will only get the periodic interest, but it cannot expand its business. So what it will do is, it already has a loan. So what it can do is, it can securitize this loan. So it has been given under a say maybe 1,000 rupee home loan. So there is a home as an underlying security. So this underlying security and this loan can be securitized. That is, it can be converted into paper, and this paper can be distributed to people who are called qualified buyers, and they will take this paper. They will, as and when the money is received, they will be given interest, etc. So as far as the bank is concerned, what it is going to get by subscription of these qualified buyers, it is going to get back money, and with this money it can enhance, it can lend it further. And what is the qualified buyer getting out of it? He is having money, but he is not having an investment avenue. So this investment in this paper, which otherwise he would not have it, he cannot give a loan. So what is he doing? He is giving money to purchase a security, which is a paper, which is generated out of a secured loan. So this process is called a securitization. So it is not necessary that only when the institution is having non-performing assets that these will be converted and entrusted to an asset reconstruction company, and they will start recovering this money and paying an adjusted value to the bank. So a securitization and asset reconstruction can happen when the institution, when the loan is good also it can happen, when the loan is bad also it can happen. So this process is what is called securitization. The institution and reconstruction. So the institution which is doing this or which can do it is an asset reconstruction company, and that company has to be registered with the Reserve Bank of India under Section 3 of the SARFAESI Act. The provision relating to regulation, licensing, that is registration, minimum net own fund, criteria for continuance of business, then regulation relating to how they do their business, all this, the power to do that is with Reserve Bank of India. This is one part, that is securitization and asset reconstruction. So dealing with non-performing assets by either converting that into paper and providing funds to the institution, or taking over those assets and getting recovery over those institutions. That is asset reconstruction and securitization. The second part of it is enforcement of security interest. That is, banks give loan against security. Say I have given a home loan, the home is the security. So tomorrow the borrower does not repay the money, I should have the power to recover, sell this home and recover money and ensure that I get back my funds. If I don't get back, over a period of time, my capital and my business will get eroded. So the bank to get back money from its borrowers is very important. So from that purpose only, there were several legislations changes which are brought about. First, because it's a contract, it used to be going and civil suit had to be filed, and that civil suit used to take decades. But here you have a security. To enforce this security, you have to again go and approach the civil court, and it used to take a huge time. Or there will be a stay and it will run for generations. So to deal with it and to take off those cases of recovery relating to of debts relating to banks and financial institutions, a new setup was brought about in 1993 called the Recovery of Debts of Banks and Financial Institutions Act, under which the Debt Recovery Tribunal and the Debt Recovery Appellate Tribunals were set up. But that institution also is saddled with so many things. The ability to get the security auctioned and get back the money was not there. And similarly, the ability to convert a loan, a secured loan into a paper, like which can be subscribed to by people who are interested in putting their money, like a pension fund or someone. These two things were not there. So to provide for the conversion of secured lending into securitized asset, you had the securitization and reconstruction of financial assets to ensure the enforcement of the security interest by lending institutions, by taking over the asset and then putting it for auction or managing it. All that was provided for in the Act through enforcement of security interest. So that is, the moment an account becomes non-performing asset, I will give him a notice. The moment a notice is given, he will have to pay back. If he doesn't pay back, then I will take over the asset. I will take over the management of his company. Then I will dispose of the asset, or I will sell the company. So these provisions are there in the security enforcement of security interest. So both these together, you have the SARFAESI Act. Then the other problem that is there is, I have a secured loan. I have given a loan against, say, this house. So whether there is only one loan against this house or there are 10 loans against this house, I don't know. So there could be instances of multiple lending against the same security. To prevent that, why not have a central registry? That is a place where every secured loan and the secured asset information is stored, a repository of that. And under that, from that registry, if I am going to check before I give a loan, I will find out that yes, against this particular house, there is already a loan in existence. Now, do I give more loan in relation to that security, or do I stop giving him a loan against this security? That decision to be taken, I need to have a central registry, a database of all the security interests to be recorded against property rights. So that is also provided for under the Act. The purpose of the Act is to regulate securitization and reconstruction of financial assets and enforcement of security interest, and to provide for a central database of security interest created on property rights. So basically, it is intended to deal with NPA problem, especially in relation to secured loans. So once the secured loan is there, if I am going to say I have a 1,000 rupee loan and my house is there, I give a notice for enforcement of security interest under section 13, then he will not pay back. So I will take over the house and I will give an auction notice. So the moment I give an auction notice, and if in auction I am only getting about 800 rupees. So my total loan that is supposed to be paid is 1,000 rupees, but I am only getting 800. Will my debt be satisfied with that? No. I will take these 800 rupees, but for the remaining 200 rupees, it will be an unsecured loan. And for an unsecured loan, the recovery will be again, I will go to the Debt Recovery Tribunal and recover my money. But if any appeal has to be made against the provisions relating to enforcement of security interests, the provision has again, the appeal lies in the Debt Recovery Tribunal only. So that way, DRT and SARFAESI Acts have been combined. As far as combined in terms of the institutional mechanisms for dealing with appeal, etc. But from the execution purpose, enforcement of security interest, and this is dealing with secured loans. But a DRT will basically deal with the unsecured loans. And now the third thing that has come about is the Insolvency and Bankruptcy Code. So this gives powers where you can take it for corporate resolution. That is, instead of going for reconstruction, or just like you go for asset reconstruction, you can trigger the corporate insolvency resolution process in case the loan becomes bad, and then you can get proposals for resolution of those assets. And if everyone is happy with it, then you can resolve the non-performing assets. So the institutions will be in a position to get back money, or even if you have to take it for winding up or insolvency proceeding, the mechanism is supposed to be faster under the Insolvency and Bankruptcy Code. So that way, in handling non-performing assets, the tools that we have is first the DRT Act 1993, then second is the SARFAESI Act 2002, then the Insolvency and Bankruptcy Code, I think it's 2016. This you have to understand. And what is a non-performing asset? An asset where money that is supposed to be paid has not been paid for a period specified by, beyond the period specified by Reserve Bank of India. So that's the period that is specified by RBI for bank to treat an asset as a non-performing asset is if the money is not received after 90 days. Not received within 90 days. If it crosses 90 days, it becomes a non-performing asset. But what is a stressed asset? So stressed asset is something where the due date is say January 1st. On January 1st, you have not paid the money. Then it is not a non-performing asset. If 90 days after January 1st, that is even considering a 30-day period, March 31st, if I don't get money, then on April 1st, it becomes non-performing asset. But the likelihood of myself getting money is stressed between the January 1st and March 31st. So in that period, the asset is called a stressed asset. That is, money that is supposed to be normally given is not given. So whether it becomes a non-performing asset or not, it is not. Unless I am taking care to ensure that I get back the money, it could turn into a non-performing asset. So an asset which is not a non-performing asset is called as a standard asset. And in non-performing assets, depending upon the recoverability of money or the duration for which it has been a non-performing asset, you have different categories like doubtful asset, substandard asset first, then doubtful asset, and third loss asset. So accordingly, if the doubtful, loss, and substandard assets keep increasing, then the bank's financial position is in doldrum. The problem that is there in the banking system now is a high level of non-performing assets. Okay, so the basic scheme of the SARFAESI Act is preliminary. You have one chapter, then regulation of securitization and reconstruction of financial assets by banks and financial institutions. Under this you have the mechanisms of securitization that is also provided for. How do you go about? Then creation of securitization or an asset reconstruction company and licensing by Reserve Bank of India or registration. Then cancellation of registration, then the power to give directions relating to this. All this are contained in this chapter 2. Then enforcement of security interest, how to go about is there in chapter 3. Then central registry in relation to taking registering all the security interests. That is the function which a central registry performs. Then registration by secured creditors and other creditors. The provisions are contained in chapter 4A. Then offences and penalties under the Act chapter 5. Then miscellaneous provisions in chapter 6. This is as far as the SARFAESI Act is concerned. Then coming to one of these topics that is important is guarantee. So what is guarantee? So I owe say Pawan about 1 lakh rupees, but I am saying that Prasanna madam will be a guarantee for that. So what is the problem? If Mallikarjun owes to Pawan 1,000 rupees, but if Mallikarjun is not able to pay, Pawan will go and take the money from Prasanna madam. So this Prasanna madam is guarantor. Mallikarjun, who owes money, is the principal debtor, and Pavan, who has given me money, is a creditor. So it is a contract under section 126. What is the contract of guarantee? It is a contract to perform the promise and discharge the liability of a third person in case of default. So the person who gives guarantee is called surety or guarantor. The person in respect of whose default the guarantee is given is called as a principal debtor. In some of these, I have abbreviated it as PD. Then the person to whom guarantee is given is called the creditor. So guarantee could be an oral guarantee or a written guarantee. But by and large, we'll see the written guarantee part only. But in a guarantee, there are three separate contracts. There are three parties. The first contract is the contract on the basis of which a loan is given or a debt is created. That is between the creditor and the principal debtor. If it is a bank which is giving a loan, the bank will be the creditor and the borrower will be principal debtor. Then the second contract is between the creditor and the surety. That is, if the principal debtor are not able to get the money, then I will approach you. So this is the contract between surety, and this will be triggered only if there is a default on the part of the principal debtor. The third is an implied contract where, in case the surety is asked to pay up the money and surety pays the money, then the money can be recovered by the surety from the principal debtor, because it is the principal debtor's obligation to pay. But because I am someone who is interested, I have indicated that for security, to ensure that he gets the loan, I am offering myself to be a guarantee. So in this business, a guarantor does not gain much, but he is only likely to lose in case the principal debtor fails. So to enable the guarantor to recover the money, there is an implied contract between the surety and the principal debtor, indemnifying the surety for the amount that he has paid to the creditor as a part of guarantee. The bank and guarantee. So here the relationship is one, either the bank asks for guarantee when it is given a loan, in which case bank is a creditor. The second case is bank also gives guarantee. It is called bank guarantee. So where bank stands surety or guarantee for the customer of a bank for various purposes, which we will see subsequently. So both these are there. First, we'll talk about the guarantee where bank is lending and it is asking for a guarantee. So banks take guarantee for ensuring safety of funds. The guarantee from person having ability to pay. So the important thing is, it is not any person that he will take as guarantee. If the principal debtor cannot pay, the guarantor should have the ability to pay. And how do you assess the ability? In terms of the net worth that he is having, that is the assets that he is having in a position to pay the amount. Then capacity to give guarantee, just like it's a contract, the fellow has to have the guarantor has to have a capacity to give guarantee. So any person excluding minor, mentally retarded or insolvent can give guarantee. The wife can give guarantee for husband's debt. Then a company can give guarantee depending upon memorandum and articles of association. Then guarantee is generally resorted to for an unsecured loan, because you don't have security. So you are asking for a guarantee. But in certain cases, even in case of secured loans, they ask for a guarantee. It is not uncommon. Then guarantee is invoked only on default of the principal debtor. So if the principal debtor is not able to get money, then the guarantee is invoked. Then the payment is sought from the surety. Then surety has to pay and can recover the amount from the principal debtor. So what are the essentials? It could be an oral or contract or written contract. It can be implied. Example, we talked about Negotiable Instruments Act and the negotiable instrument. So one, there is a endorser, there is an endorsee. Okay. So if the obligation, there is an acceptor who is supposed to be paying the bill of exchange. So the endorsee will go, or the holder will go and ask the acceptor to pay the money. The acceptor does not pay. So acceptor is the principal debtor. So if he doesn't pay, then the obligation is the endorser will become the surety for the acceptor in case he defaults in payment. So this is an implied guarantee. Then the party must have capacity to contract. Similarly, like a contract, it requires lawful consideration. The benefit to principal debtor in the position in the form of getting ability to get a loan is enough consideration that can be there for a guarantee. Then consent of surety should be free and not by misrepresentation or concealment of facts. Then existence of a debt which is recoverable and the liability that is legally enforceable is very important for a guarantee. Otherwise, for what you are standing a guarantee for. Then promise of surety is conditional on principal debtor's default. Then it is intended for the security of creditor. Then surety can proceed against the principal debtor once he discharges his liability of the creditor. And liability of the surety is coextensive with that of the principal debtor. That is, the liability will be there as long as principal debtor is liable, surety will be liable. The moment principal debtor's liability is over, surety will no more be liable. So this liability is coextensive with that of the principal debtor. So here, other feature is three parties, creditor, principal debtor, and surety. Three contracts we have already discussed. Then requires concurrence of three persons who are parties. Then principal liability of debtor, surety assumes secondary liability. Then after payment, surety can sue principal debtor in his own right. Okay. Then guarantee does not get anything, but principal debtor and creditor get benefited. This is the fact of life. Type of guarantees, kinds of guarantees, you could have specific guarantee where there is a single debt. As long as the debt is there, the guarantee will be there. The moment that the repayment of the debt is over, the guarantee is discharged. This is called a specific guarantee. Then continuing guarantee. Then you have maybe a cash credit loan or a overdraft loan. So as and when you are drawing from that, it is individual transactions that you are availing of. But the amount which is there as a loan against the principal debtor will keep changing, but the guarantee will continue. So this kind of a guarantee is what is called as a continuing guarantee. The amount will keep fluctuating. The drawals can be individual installments, but till the period that the loan is continuing, it's a continuing guarantee. This, at any point of time, it can be revoked by the surety, subject to informing those people. Okay. Then joint or several guarantee, where more than one person jointly execute an agreement to guarantee, then the liability will be joint and several, unless it is specified. So if they say it is joint liability, then if they say joint and several liability, it is everyone will be liable. So imagine that there are three persons who are standing surety. So then the bank can take action against all the three sureties and ask for amounts of the loan from each of these surety for the full amount. So now once one of the guarantors pays, then he can in turn get the money recovered from the other co-guarantors, they are called. So there could be a joint guarantee or several guarantee. Okay. But if there is nothing which is mentioned and there are more than one person, it is joint and several guarantee. Okay. Liability. Then limited guarantee. So here the guarantee can be limited in terms of the transaction or in terms of the amount for which he stands guarantee. So I can say that I will give him a loan of 10 lakhs, but I want a guarantee for 5 lakhs. So here it's a limited guarantee. If I am going to have a single loan of 10 lakhs and the guarantee is for that loan, then it will become a specific guarantee. If I am going to have a loan of 10 lakhs in the form of cash credit, till the time that cash credit account is going on, it is a continuing guarantee. So these are the different kinds of guarantees. Then what are the rights of surety? As I told you, first right is right of subrogation. Subrogation means actually if the principal debtor does not pay, creditor will take action against the principal debtor, but he is asking the surety to pay. So now surety will pay the money. So now surety steps into the creditor's shoes, and he will be in a position to recover money from the principal debtor. This is what is called right to subrogation under section 140. Then right to security. Suppose the bank has taken security for the loan and the surety has paid, then the surety has to be entrusted with all that security which the bank has given. So he will have a right to security that the creditor has taken or holds of the principal debtor. Then right to be indemnified by the principal debtor, section 145. So implied promise. So in case the surety pays, it is implied that the principal debtor indemnifies to make good the amount that is paid by the surety in terms of the contract of guarantee. Then right to contribution, if there are more than one guarantors, as I told you, 1,000 rupees loan, then 3 guarantors are there, then all the 3 they will issue. And if one guarantor pays 1,000 rupees, then he can collect 333 rupees each from the other 2 persons. So this is right to contribution. Then right to information. So what is the amount of loan that he has taken, how he is drawing, how he is managing, these kind of things I can ask, because my liability is dependent on that information. So I will have right to get information in relation to the liability of the principal debtor. But how much bank balance he has got, all those things I cannot ask. My right to information ends insofar as the liability in relation to which the guarantee is given. Then right to set off. So before he asks me, I can say, did you not use up the money that is there in his savings account? So use that first, then whatever is remaining, I will pay. So suppose there is a 1,000 rupee default, then he is having 50 rupees in his account. Then I can say that you first set off whatever is supposed to be given. Then this can be raised as a defense, and it will be open for the counterclaim to be made to the principal debtor. Then right of the creditor is right to demand payment from surety immediately after the principal debtor defaults, and not till all the remedies against principal debtor are exhausted. And right to recover dues. If the surety becomes insolvent, the creditor will have right to recover dues from the estate of the surety also. Then he has right to sue the surety after exhausting all remedies against the principal debtor. These are the rights. And obligations of creditor to surety is not change the terms. So any of these obligations, if the creditor does not meet, then the surety will be discharged, because all these affect the rights of a surety. One, changes in the terms of contract between him and the PD without surety's consent. So the terms have changed. So now the surety can say that I am no more involved in this. So I am not aware what I was initially given, what I have had initially. You have changed those terms, so you have not kept me in the loop. So I am not bound by whatever you are doing. Then the second thing is not release or discharge the principal debtor. So if he releases the principal debtor, then the surety also is coextensive, so he will also be relieved. Then if he gives a loop to indulgence, means if he is petting him and saying you give after 1 more month, 5 more months. If he is doing that, then the surety will be discharged. Then not act against the rights of the surety and not omit any duty surety requires creditors to do. Like if he is having securities and he is giving back the securities to the principal debtor, then the moment the surety is invoked, he has right to the security. But here the creditor has given back the surety. So his rights have been affected. In that case, the surety will be discharged of the obligation. So all this he is not supposed to do. So how will the termination or discharge of surety happen? One, by revocation. In case of a continuing guarantee for future transactions, he can give a new notice and he can walk off from the obligation to be a surety. In the death of the guarantor, unless there is any other contract saying that if this man dies, then his son will be the surety. If that kind of a thing is not there, if the man dies, the contract of guarantee dies along with him. Then any variation in terms of contract without surety contracts, like what we have seen earlier, then by variance or departures of the terms of contract of guarantee, so that also I am not bound. So these are the things which I agreed to. Now you want this to be changed, I can say that I don't want. I am discharged of my surety obligations. Then by novation, that is, novation means substitution of one party by another party. One contract by another contract, one creditor by another creditor. Suppose I have a State Bank of India loan and Mallikarjun taking a loan from State Bank of India, and the State Bank of India has now sold the loan to say Citibank. So this loan is now novation will happen. That is, the creditor will be replaced by Citibank. So by this, I will not have any obligation to pay Citibank. My obligation is only in relation to State Bank of India. Similarly, Mallikarjun has taken the loan, but now Mallikarjun is no more and Aditya has come into the loan and the loan is continuing. So now this is again an innovation where the party, principal debtor has changed. or similarly the contract itself has changed. So in these cases, since the terms themselves have changed, the guarantor will be discharged and the guarantee will get terminated. Then where there is a release or discharge of the principal debtor. So if the principal debtor is gone, the surety's obligation also goes. And creditor compounding with the principal debtor. That is, if 1,000 rupees are due and he is saying that you give me 500 rupees, that is enough. And he cannot say that I will recover 1,000 rupees from the surety. If the moment he is compounding it with the principal debtor, the surety will be discharged. Then loss of or parting of security by the creditor. This I have already discussed. Then change in legal position of parties like constitution of firm, etc. A merger or amalgamation of company. In all these cases where the parties themselves and the nature of parties has changed, the guarantee will not remain the same. Then surety is not discharged if the contract to give time for principal debtor is with a third person and not the principal debtor. Forget about forbearance. Okay. Next, we come to the bank guarantee. Here, in certain instances, while you are entering into a contract, say you want to construct a road, you are the contractor. So the government wants this to be done within 1 month. So it wants to have security saying that you will complete the job in 1 month. So it will say you bring in some amount and then put it with me. So instead of putting that money, what it can ask is you bring a bank guarantee. So bank guarantee, because you are his customer and he is aware about what you are, a bank guarantee will act as a substitute for providing you with security about you. So that is a bank guarantee. So bank guarantee is a guarantee issued by bank on behalf of its customers. The bank undertakes to pay the guaranteed amount to person in whose favor it issues a guarantee. So here, suppose the APSRTC or say Road Transport Corporation is that road. CPWD, you are laying a road. So CPWD has given you a contract to build these roads. So CPWD will be the beneficiary. And if he asks, bring a bank guarantee of 1,000 rupees from say Indian Bank. The Indian Bank will issue a guarantee and in favor of CPWD with Mallikarjun as the customer. So Mallikarjun is the contract person. CPWD is beneficiary. So if Mallikarjun doesn't construct the road according to the contract that is entered into, CPWD will ask money from bank. So 1,000 rupees is paid by the bank to CPWD. This is a bank guarantee. So for this purpose, fee is generally charged or a commission is charged by the bank. And the commission amount will depend upon the amount which is there and for which it is standing guarantee, and the counter guarantee which is given by the customer is the guarantee that is there. That is, if he pays 1,000 rupees, then this 1,000 rupees will be as good as a loan given to me. So I will be responsible to pay back this amount. So the paying back of this amount is the guarantee on the basis of which the bank gives guarantee. So it is not that it can give this to any Tom, Dick and Harry. My ability to execute the contract, my ability to pay back the money in case the guarantee is invoked, and my general nature, all these have to be taken into account before it gives me a bank guarantee. Then bank guarantee is basically a contingent liability, a liability which is dependent on a contingency taking place or not. What is the contingency? My obligation, whether I am fulfilling or not. If I am fulfilling my obligation, BG is not invoked. If I don't fulfill, then the guarantee is invoked. So it's a contingent liability. If the customer fails, the guarantee is invoked and bank is bound to pay the amount of guarantee. If the amount is paid, if it is not paid, then it is fee-based. If it is paid, it becomes fund-based. Then limitation for invoking the guarantee, 3 years from the date of invoking the guarantee as per the terms. In case of government, 30 years. So within that period, he can take the matter to court. In case of bank, if he pays, bank can recover as if it is a loan to the customer, and the limitation period in relation to that will apply. And types of bank guarantee, you have about 5 types of bank guarantee. First is a financial guarantee. Sometimes what it happens is you want to and do a contract for say CPWD. So what CPWD will say is, to ensure that you are performing this task on time, you put in about 1 lakh rupees. Okay. So in putting in that 1 lakh rupees, I am blocking up my funds. Instead of that, what CPWD can ask is you bring a bank guarantee. So if you are performing your according to the terms and conditions of the contract, bank guarantee will not be invoked. But if you are not performing, the financial implication will be there and the money will be asked to be paid. So it is as good as an earnest money or deposit that is made, security deposit kind of a thing. So in place of security deposit, you are giving a bank guarantee. This is called a financial guarantee. Then second is deferred payment guarantee. So this is also a financial guarantee, but for guaranteeing payment of installments over a period of time. Suppose you are taking an export credit, okay, that is, or you are taking external borrowings, commercial borrowing. So in that particular case, you are supposed to be producing things and then you are supposed to be exporting it. You are supposed to be using that in your business and paying the principal and interest. So the payments are spread over the period which is there for which you are receiving credit or you are being given a loan. For that particular period of time, you are supposed to be protected, and that protection is given through a deferred payment guarantee. So as long as you are paying or you are sending the goods, it's okay. But the moment you are not sending the goods, then this guarantee will be invoked. So once your obligation is to send goods, if the goods are defective also, you cannot question. So this is as far as the deferred payment guarantee is concerned. Then the next kind of guarantee is what is called as a bid bond guarantee. So imagine that I was talking about you participate in an auction for taking up a contract. Say Air India you want to purchase. So Air India says, government says that I will put Air India for auction. So it says that you give bids. So just like that, I will also go. Ambani and Adani are also giving bids, and I will also go and I want to give a bid. Say 500 rupees I want to purchase. So will you be in a position to? So it's just like child's play. I'm going and I'm participating without having any ability. So I will say 500 crores I will buy. So to prevent these kind of frivolous people to come into the bidding process, and also to ensure that there are no fake bids which are there, to deal with that and to ensure that only serious players are there, the government may say that you provide this much money as earnest money or security deposit. So if you keep this much money, say 10 crores, only then you can bid. So the 10 crores, they don't ask in the form of money, but they will ask in the form of a guarantee. And the moment the auction takes place, the obligations under the auction, once you are successful, you are supposed to go and pay up the remaining amount. So for ensuring that you are going to be bound by the consequences of your participation in an auction process, and to make the auction process a process of serious players only, and to prevent fake bids, the protection is ensured through a bid bond guarantee. Here, the guarantee is given when you are participating in the auction. The moment your auction result is there, this guarantee will be returned. Or if you don't comply with it, that guarantee will be invoked. Then advance payment guarantee. So this is, imagine that you say that I will give you say 1 lakh, what is it, 1,000 crore worth of shirts I am going to send it to you. So then the other party will be worried whether will this fellow be in a position to afford this much money. So he will say that you provide, well, will he be in a position to buy this much cloth for providing me with these shirts? So he will want to have an advance made to give an indication about his ability to execute the delivery obligations. So he will say that you put in 1 lakh rupees to show that you will be in a position to give 1 crore worth of shirts to me. So this 1 lakh that he is giving, calling for an advance, he may ask for it to be given in the form of a guarantee. This guarantee is called advance payment guarantee for meeting contractual delivery obligations. So the moment I am sending it, while you are adjusting, you are paying my money to me, at that time you will reduce the amount of this advance payment guarantee and then provide me with this money. So that is the guarantee which is called advance payment guarantee. Advance guarantee has a term that advance amount can be reduced from the value of any part delivery or shipments made. Then performance guarantee, so basically compliance with the terms of contract and performance by customer of the conditions of the contract entered into, and in the event of default, financial liability on behalf of customer as per the terms of the contract. So I will have to construct a road. That road has to be of this particular quality. If that road is not constructed by this particular due date, or if it is not of the quality, then I will invoke the guarantee. So the performance under a contract is something which is there, and for that a guarantee is supposed to be taken. So here, irrespective of the dispute that you have in relation to the quality of the road, etc., between you and CPWD, if the CPWD says that I want to invoke the guarantee, it can invoke. Okay, it is a bilateral contract between the bank and the beneficiary. In this case, CPWD. So if CPWD says that the performance is not okay, he can invoke the guarantee, notwithstanding the dispute between you and CPWD. Okay, this is generally required in special infrastructure projects, etc. So here, the enforceability is merely by demand, and it is absolute. Or it could be saying that if they show proof of breach of contract, at that time it can be enforced. So these are the types of bank guarantees. Then another small aspect is relating to garnishing order. So this is I'll tell it in the form of an example. First, imagine Ajay gave 10,000 rupees to Babu. So here Ajay becomes the creditor and Babu becomes the debtor. So ideally Babu should repay. So Babu did not repay the amount. So Ajay went to court for recovery, and the court issued an order in favor of Ajay for recovery of money from Babu. So here Ajay has an order in his favor, so he is becoming a judgment creditor or a decree holder. Then Babu is supposed to be making payment in accordance with that judgment. He will be called a judgment debtor. So Babu says he has no money to honor the decree. So, but Ajay gets to know that he has money in Canara Bank. So here, Canara Bank owes money to Ajay, is what he has information about. So Ajay says Canara Bank is the judgment debtors, that is Babu's debtor. That is, he owes money to Babu. Then Ajay applies to the court for an order against Canara Bank to pay money from the account of Babu to him. This order that is sought is a garnishee order, and Canara Bank is called the garnishee. Someone who is a judgment debtor's debtor is a garnishee, and the order which the court issues against Canara Bank to pay the amount owed by the bank to Babu to Ajay is a garnishee order. Okay, so in this particular case, the moment he applies, the court first gives an order nisi. That is a preliminary order kind of a thing, which is valid unless the affected party comes back. So once this order is issued, it has to show cause why this order should not be made absolute. So what, the moment this order is received by the bank, what they will do is stop the payment to customer. Then imagine that he is saying that this is Babu's money that he is having, but Babu's, it is actually a Babu's joint account with someone else. So it is not actually Babu's account, but it is a joint account. So the bank will say that it is not Babu's account, so it's a joint account, so I cannot pay you the money. So this kind of explanation why the amount cannot be paid will be given by the bank. And other instances, it will also be informed to the customer, saying that this money is going to be utilized. So you better be cautious or you make the payment of the decree. So that is, once this explanation is given, after hearing the parties, the other order that can be given is an order absolute. So once the order absolute is given, after an order nisi is passed and the explanation is heard, the final order is to banker to pay the amount in Babu's account. So that will be a garnishee order. It could be a limited garnishee order saying that you only attach a limited amount, or it could be an ordinary garnishee order where the entire balance of that particular person with the bank is attached. And how is this order served? It is served on the head office with time to intimate all branches. But the moment a garnishee order is received, all accounts in the customer's name and the funds in the bank's hands have to be frozen. The loans payable to the bank have to be set off, excluding uncleared amount. So imagine that I have a arrangement with the bank. So I have given a check, but that amount of 10,000 rupees I have given, that has to be received from, say, another bank. The bank may have a tendency to credit the amount. So that amount, or the checks that are supposed to be paid during the day, so those amounts can be adjusted, and whatever is the balance actual on that particular day, that will be the amount which will be subject to the garnishee order. Then any checks received subsequently are returned with a refer to drawer remark. Then if further payments are received into the account, they are also not taken into this, but they are kept in a separate account. But during the time a bank's garnishee order, a court's garnishee order is in existence, if the bank pays money, then it will be liable for that amount. Then garnishee order is not applicable if and when relating to one, the name and description of the customer account in order is are different. So I have a different name and here and there, then it will be a 1 minute. Is inaccurate. So if there is any inaccuracy in the name of garnishee order and the account holder, then I can say that that will not apply. Then money held by a customer as trustee or held in a joint account or in a firm's account or company's liquidator's account. So that will not be something which will be coming within the garnishee order. Then bank does not owe any money to the customer. In that case, no garnishee order will apply. Then the account is overdrawn. That is, there is no balance, but there is only a due payable to the bank, not due payable by the bank. Then after set off the balance, there is no amount in the account. Dues payable to the bank will be set off from the dues payable by the bank. In that remaining portion is only that which can be paid. Then money held abroad cannot be brought under the garnishee order. Then securities that are kept in safe custody, the value of those securities you cannot have a garnishee order. Only the money that is available will be there. Then proceeds of sale of share stocks not received, so those cannot be taken into account as forming part of the garnishee order. Then amounts received after the date and checks realized after the date. So it is the position on that particular day that order is received. So neither before nor after. So money that is coming afterwards, they will not be subject to that order. Then bankruptcy of account holder, winding of the company, they are also not covered under the banking law. So I know that there are several aspects that need to be covered, but in 5 hours, you will not be in a position to cover everything in the banking law subject. So it's too much to expect that. So known is a drop, unknown is an ocean. You need to go through these aspects. So Tanning's law on banking is one book which is having a lot of information, but you can refer to banking law book of, say, Maineni. You can go through the book of, even for undergraduates, you can go through the books which are there of Bangia books. Those kind of books you can refer, and then you can do well. Okay, all the best. Thank you.